Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what's going on the markets?
Hey, thank you, Jeremy. Thanks for our listeners jumping on another call. Wild ride. I mean, we're talking about a sell-off. We had the U.S. equity selling off led by geopolitical tensions, oil, inflationary concerns, so on and so forth, that we'll touch on in a little more detail in a minute. But we saw the Nasdaq Composite fall about 3%, or just over 3%. And we saw the S&P 500 decline too, but the Russell 2000 outperformed slightly on the upward side. So what sectors and what were their performance? The big gainers, surprise, that was energy and materials. Energy was up 5% and materials up 4%. So what led the downside? We had technology off 4% and communication services off 4.5%. Now, if we look at rates and the bonds, we said, rising energy prices fueled that inflation concerns. So that was pushing bond prices down and raising those yields. So we saw the 10-year Treasury yield hit an 8-month high. Now that was nearly 4.48%. That's almost a 50 basis point move in 1 month. So that's a big move in 1 month. Weak demand also followed through or came through with the Treasury auction, just putting additional pressure on those bond prices. Mortgage rates for the 30-year fixed mortgage rates rose to the third straight week to about 6.43. So they've been moving up with those bond yields overall. If we look at the Federal Reserve and some U.S. data, we had the federal officials voice their concerns or having growing concerns about the war, the geopolitics that are going on with all that, and how that'll affect inflation, growth in the economy. But we did have the PMI data showed some business activity slowing to an 11-month low, while input and output prices did rise. Import prices jumped about 0.5% month over month. Now that was the largest increase in nearly 4 years. Consumer sentiment, that fell to 53.3. That was a 1 year with a 1 year inflation expectation to 3.8%. Internationally, we had the UK and the Eurozone private sector growth stalled. Manufacturing prices did rise rapidly, putting pressure on inflation, really causing them to increase interest rates. We did also have the ECB President Lagarde warn of potential forceful action if inflation stayed above target in terms of what they're going to do with their rates. We had Japan's new core CPI measure showed about a 2.2% year-over-year inflation, with the BOJ minutes revealing some hawkish tilt here in terms of their rate path. Now, the week ahead, we ended up with some quarterly weakness. We had the Q1 end with the S&P down 7%. Key drivers, not surprising, you probably all know this. We got a geopolitical event going on. We had the Iran conflict. We had real questions of the effect of AI, artificial intelligence, on certain companies' markets, so on and so forth, as well as private credit concerns in the private credit markets. Labor markets, we had the March non-farm payrolls. That's due out on Friday. They're expected to rebound 50,000 jobs after February's surprise of a loss of 92. We'll have the JOLTS job openings, the Challenger job cuts, and the ADP private payrolls coming out. Federal Reserve outlook and their expectations. Then, with some other data rolling out, keep your eyes out for the ISM manufacturing PMI, some retail sales, and then kind of wrapping some things up with the consumer confidence numbers. Then we'll look overseas with Europe and the UK and their, let's say, dependence on energy and the effects of the geopolitical events with Iran affecting inflation and what steps they might have to make. Jeremy?
Graham, you had mentioned talking about the Fed and maybe, a lot of conjecture and some conversations going on about the Fed maybe raising rates instead of lowering. What are your thoughts on that?
I think that's an extreme conversation to have. Right. Absolutely don't feel that the Fed's going to raise rates, because let's think about this. There'll be a point break here. If we have inflation rising because of geopolitical events and pressures, that doesn't mean that's a case to raise rates because we have oil higher oil prices that also can bring down demand and slow earnings growth, slow the economy. So I'm not in the camp of higher interest rates. I do not think that would be good for the economy right now. I think flat to down is probably somewhere you need to place your bets.
Gotcha. Well, Graham, we always appreciate the information and expertise. And thank you for our listeners checking in with us every single week. And we look forward to seeing you next time. Have a great week.
Take care.